our break even on this one. The only difference here is, as you can see, once we get to 95, that expiration graph for that call, that covered call shifts and goes straight right. We don't get to make, we don't get to participate in the upside beyond 95 because we did sell that particular covered call. So this leads me back to my original point, which was this is a neutral to slightly bullish position. Ideally, whether you're selling for income or selling to liquidate a position, you would like it to be right at that expiration or that strike price at expiration. That would be the ideal outcome. At that point, you can make a new decision, decide if you want to do it again, or if you want to maybe think of a different idea, or if your outlook has changed. Maybe you think the stock is now bullish and you don't want to mess around with it. Absolutely can do anything, but ideally it would be at 95. So now what, right? Strategy management. Well, a couple of things that we can do. And really, I'm going to make it just essentially two because I'll come to roll last. But we can buy to close. As Andrew pointed out during the homework, if we are selling to open, how do we get the position to go away? Well, we buy to close. And one thing I'll mention about this is that when we sell a covered call, so in our example, we sold a covered call for $1. That means that our maximum profit on that covered call, for at least the covered call aspect, is $1. Not going to make more than that. What happens if we see that maybe time has passed and the stock hasn't moved, or maybe the stock has moved up slightly, basically our outlook, right? Neutral to slightly bullish. And all of a sudden the call is only worth about 10 cents. What can we do? Well, this is something that we want to call not, risk management gets kind of a bad rap. It always thinks about downside, but what about reward management? You got it right. The stock has, remained relatively unchanged. The option is now worth 90 cents less than when you sold it. Is 90% of your total profit enough for you to take some chips off the table? I would argue that a lot of traders think it probably is. And so they'll spend that 10 cents to buy that option back just so they can say, "Well, I'm done with that trade. I don't have to worry about it any longer." Or if there's any kind of odd rally for whatever reason, I'm done with the trade. And then I can start anew and try it again. So you can absolutely buy to close. And if you could get an opportunity to take some chips off the table, do some reward management, that's never a bad idea. For that particular one. You don't always have to wait for that last 10 cents because that certainly there's no guarantee it's going to happen, right? We can see any kind of situation change. Even now, we were just a tweet away from from an odd market move. So it's a good idea to think about that as you trade these things. The other, of course, is let it expire. If you are finding that it's, out of the money, you can let it expire. If it's in the money and, you feel like you're okay with losing the stock, you can let it expire. It's really depending on what it is that you were trying to accomplish with that particular trade and what is your risk levels. And finally, the roll. The reason I kind of skip over this one is because rolling an option is just a fancy way of saying I'm closing out my current position and opening a new one. We can absolutely roll. What if that same scenario where you had on that call, maybe the stock has moved down slightly, or maybe it's even just kind of sat there for a week or so, and now all of a sudden that option is worth about 10 cents. What could we do? Well, we could, again, buy that one back and roll it into a new short call position, maybe a strike high or so. You have the ability to take some chips off the table and stay in the position. That's what you're doing with rolling. You're just simply buying to close the current position and you're selling to open a new one when you are rolling strikes. And that is a viable strategy. But let's make sure that when we do start to roll positions, that we're doing it for the right reasons. We're not trying to, chase a bad trade. We're going to have bad trades. That is absolutely part of the deal when you're trying to trade options, especially when you're trying to trade options. The last thing we want to do is try to throw good money after bad to recoup what we lost. There's often times where someone will sell a covered call and the stock just goes straight up, and now all of a sudden they're faced with the idea that they're going to have to sell their stock at 95 versus 105 where the current market is. So what do? They buy back the option and try to sell a new one for at least the same amount of premium to make up for that loss. Well, if you do that, what happens? You're either A, much closer to at the money to gain that premium, or B, much further out in time. So you're not really doing yourself any favors by extending what potentially was a bad trade and keeping yourself locked in for even longer. So again, let's make sure that if we do roll a position, we're doing it for the right reasons. But that is the basics of the covered call. Again, very oftentimes one of the first trades that we do, but it's important to understand what the covered call is, and that is, of course, a neutral to slightly bullish type of trade. Understand the obligation that you are faced with if that does get into the money. And don't forget, you still have exposure and risk to the downside because you still own the long position. But a cover call can be a great tool in the right circumstances. So, Andrew, I know I've been going on for a while. Anything you want to add before we move on to the next thing?
Yeah, when I think about covered calls, as you mentioned, this is generally the first strategy people tend to start with when it comes to options trading. And it's a natural segue for a lot of people to say, well, hey, I have shares. There's this option strategy that, especially if you've been advertised this strategy to the extent of people say things like, hey, make yield on your stock, collect rent on your stocks, add a dividend synthetic yield to your stocks. You'll hear all of these things. And I'm not here to dissuade people fully from the world of covered calls. I just want to make sure that we think about them in the right light because, as mentioned, the two things that I notice people tend to gravitate to is they love the thought of income in the sense. I mean, who wouldn't? Who wouldn't love the thought of some sort of mailbox money that they can collect on their stocks? But the two analogies, or really the two follies of sorts, that I notice people run into with covered calls. One, we assume that the stock can only temporarily go down and eventually will always go back up. And if you've been in the markets for long enough, you know how not true that is. You will know that all stocks can and often do go down over long-term periods of time, especially if we are trading individual stocks. Maybe you'll say, hey, Andrew, I know that we've had some crazy bear markets, corrections, things like that in the broad indices, but that's eventually always gone back up. And I'm not here to sway you from that. I hope that that is always the case with broad-based markets. There's a natural survivorship bias in the S&P and NASDAQs and things like that because the bad stocks get taken out of it and the good stocks get added back in. So you effectively believe almost always it will eventually go back up. So then that leads us to the next issue, the next folly is that one, if we can survive those periods of downtrends, one, for covered calls to work for us, and that means if we're doing it on a kind of regular basis, non-discretionary capacity, we're kind of rinse and repeat it on a regular basis, well, then are we potentially going to miss out on some upside? And to me, that's the whole point of owning shares in an underlying is the upside. We want to make sure that we get as much upside as possible. And that's the thing that I emphasize most when it comes to covered calls. It's not to say that they can't be used. It's not to say they can't be useful in scenarios. It's not to say that there aren't scenarios for a covered call. But the thing that I just emphasize most when we are selling a covered call is we are selling someone else our upside potential. Someone else gets our upside in that stock if it does go up past the strike price. What we need to have happen is basically the market to constantly, or at least when we put on this trade, overprice upside expectations. If we say that in this scenario, we bought this stock at QRS $92, we think it's not going to go much higher than 95, or if we do see it go above 95, we're okay with not having it. And we see the market's willing to pay us $1 for that. That is an okay sort of thought process. If you're just thinking, hey, I'm going to sell $1 because the day on the calendar changed and I do this on a daily, weekly, monthly basis, well, the issue is if we approach cover calls through the lens of always wanting to sell and collect that income, the question you just have to ask yourself, why would anyone ever be on the other side of that? If you could consistently just sell an option every day, week, month, or however often and collect that money, why would anyone buy it? Why would anyone be on the buying side of that transaction? So I always like to spend a little bit more time on the cover call side of things because again, it's naturally where most people begin their options trading journey. So let's look at, just a few different examples. One, let's just go ahead and pull up an option chain. Let's say on NVIDIA, something that's a little bit more well known currently, one of the largest market cap names, and you're thinking, all right, we've got, what is this, maybe right at a month between now and the April expiration. Imagine you have 100 shares of NVIDIA. You have them at 184. I am assuming that you have them because you're bullish on the company. Maybe that's not the case, but generally speaking, you have these shares because you're bullish on the company, ETF, or whatever it is. Well, right this moment, someone's willing to say, they think it's going to get above 200 between now and April. If you think it's not going to get above 200, well, the market's willing to pay you. a decent amount for that. What is that, 1 to 2% relative to that? If you can make that on a monthly basis, then that's a pretty decent yield. What is the issue though? As mentioned, what if the stock goes to, I don't know, 210, 220, 250? Are you going to be upset that you missed out on some of that expiration or that appreciation? I saw someone asking, is if the QRS call or any call that we sell does it get exercised and that thus we get assigned, couldn't you just buy back the stock? Yes, yeah, absolutely. You cannot by all means do that. But imagine a scenario where let's say you buy Nvidia right now, you hadn't had it before. You buy it at 184, you sell at 200 strike. So in that case, you buy it for 184, you brought in, let's just say $3, I'm rounding up here. So in that case, you've basically bought Nvidia at 181 and then you get assigned at 200. That's a good trade. Let's not shy away from that being a nice 10% trade in a month's time. But what if it goes to 220? Now you get assigned to 200. And if you wanted to be bullish on Nvidia, you could buy it back at 220. You just missed out on an additional 10%. Maybe that's okay with you. That's just the criteria, the calculus. I just want to make sure everyone at least starts in that approach with is that when we sell that cover call, we are selling someone else our upside to that extent. And I always like to show one great tool on Active Trader Pro Legacy, which of course it's not currently anywhere on that Fidelity Trader Plus just yet, but there's a very good, cool tool on the options. If you go to options and if you go to strategy ideas, you can actually backtest a cover call strategy over the last 2 years. It does make some assumptions. It is a 2 year backtest. It sells a covered call on a monthly cadence around that monthly expiration. And then no matter what, it will roll it during that 30-day time frame. It will roll on the last day before expiration and assumes you're not going to get early assigned. That is a kind of untestable sort of variable in that sense of whether or not you get assigned early if someone decides to do that. But ultimately, we can see what this strategy would have done for the last 2 years. So let's see. Had you been consistently selling an out of the money call on the SPY for the last 2 years, you would have brought in about 13.6% annualized. Wouldn't you know it though? Not doing that, just simply buying and holding the shares, got you 14.5%. So you basically got an extra 1% annualized to not do anything, to just hold the stock, to close your eyes, close your laptop, wait and wake up 2 years later. And in that case, not only did we make a little bit more by not doing anything, we didn't really increase the risk because the downside risk is the most important risk in this scenario. And we just also didn't have to do all that work. The amount of effort it takes to do this on even just a monthly basis to figure out what calls to sell and when to roll it, things like that. If we had an automated system, maybe that makes it a little bit easier. But as we're humans and we maybe pick and choose our spots, we didn't get any sort of massive outperformance. I mentioned Nvidia. Let's look at what Nvidia has done over that period of time. Had you been doing this on Nvidia, 30% out of the money calls, 40% though, just buying and holding. Again, that is an important distinction. Why and how does that happen? Well, for both of these, the thing that creates a scenario where selling the cover call underperforms buy and hold is periods of time when the market went up more than what the market was really anticipating it to go up by. That's what determines those call prices. People buy those calls because they think it's going to go higher. People sell those calls because they don't think it's going to go higher. And in scenarios where the market was under pricing upside expectations, those cover calls are going to underperform. And in that scenario, do you run into a situation where you miss out? I remember talking to traders more specifically during this phase. It's so quaint now in hindsight, but let's change this to a logarithmic. We went from a split adjusted $10 to $50. That was $100 and $500 pre-split. I remember talking to people who they had shares that they bought at 100 to 150 and they sold calls at 200 or $300 thinking, hey, if it ever gets to 200 or $300, they'd love to sell it there. And I forgive them for doing that because that made a ton of sense. But with the benefit of hindsight, it went to 400, 500, $1,000 per share. And wouldn't you know it, they're kicking themselves for having sold those calls because they did not anticipate it could possibly go that much higher. We don't have a crystal ball. We don't know the future. We just have to be okay with those totality of outcomes. That's the thing that we just have to emphasize most with a covered call. There's an asymmetric relationship to a covered call strategy. We have the full downside risk that we had by owning the shares, and we have capped upside potential. If we were just owning the shares themselves, we kind of have that binary of outcomes. We get all the upside, but we take on all the downside to zero. There's still maybe some asymmetry on the tails there that a stock can double, triple, quadruple, can only go down 100%. But the issue is, say on that QRS stock, what have we ultimately done? If I switch back to this slide deck, we have taken on the potential for best case scenario. If the stock goes up 1,000%, the best case scenario for us is that we can only make $4 per share. We can only make the $1 that we brought in by selling the 95s. We can only make the $3 between 92 and 95, four total dollars per share. What's the total risk? Well, the $1 reduced our break-even price by $1. So $91 is now our cost basis effectively. If this stock goes to zero, we lose $9,100. And you might be thinking, hey, how often does a stock go to zero? It doesn't happen often. I'm not here to say that companies go bankrupt every single day. I mean, maybe in the outskirts of things, but plenty of stocks do indeed go down over long-term periods of time. In fact, let's look at one where, just a quick aside, I don't mean to pick on Beyond Meat, but this one is down 70% annualized. So it went down 70% and then went down 70% again, just to show that on a chart, as weird as that math can feel. That's the thing to always remember about percentage changes. They can always get worse. So in the last few years, this stock is down, I want to say 99% from its highs. Let me make sure I have this dragged here. Yeah, 99.5% from its highs. So when you know it, had you been selling covered calls, you wouldn't be down nearly as bad. You'd be down 15% annualized because you'd be taking in some premium along the way. But will you feel that great about it at the end of the day? That, hey, instead of being down 70% annualized, you're down 40%. I think you'll still pretty upset because the substantial amount of your capital was in the shares themselves. That's the issue that we have to think about in scenarios like this. And that's the issue that you have to think about when you are entering in a cover call strategy. The real risk is downside. If it goes down, you will probably forget that you brought in $1 on those calls that you sold. Because if it's down $10, $20, you might be thinking, all right, well, yeah, that $1 is nice, but who cares? I'm down to $15. So that's the real capital risk that we have to think about. So then from there, next thing that we think about is the other side of that, cash secured puts. You might be still familiar with these because they share a lot of similarities to a cover call in their approach. So when we sell a put, rather than selling a call, when we think about why a covered call is called a covered call, what is the deliverable component of being short a call? Well, if we have to sell shares when we are short the call, the call holder has the right to buy the shares, so we are obligated to sell them shares. Having the shares already is what makes it a covered call. We basically already have set aside the deliverable component of the short call. So then what is the deliverable component of a cash secure put? Well, if someone has the right to sell the shares when they buy that put, the person who sold that to them is obligated to buy those shares from them. So instead of setting aside shares, because there's no point to set aside shares for a cash secure put, we set aside the cash that we will need to be able to buy those shares if assigned. That's the simple thought process of just setting aside the deliverable component of both of these transactions. The deliverable component on a sold call is shares. You have to sell those shares to someone. The deliverable component on a cash secure put is cash because we have to buy those shares from them. So that's all that we're doing, is that when we sell that put, the account itself automatically sets aside the cash value of having to buy those shares at that strike price. Now, it mentions here, obligation to buy the stock, profit potential limited to the premium just received, substantial downside risk. You have to have the amount of cash. So why do people do this? They maybe be wanting to target a buying price. Maybe they want to earn some income or earn some interest in this case. So imagine a scenario on QRS stock again. Imagine we see that we have $9,000 of cash burning a hole in our pocket in our account. We're looking for something to do out there. And we see that QRS stock's trading at 92. We are neutral to slightly bullish. You will remember that's what we effectively said for covered call, neutral to slightly bullish. Why is that the case on a covered call? We want the stock to kind of go sideways. We're okay with it kind of going up. We don't want it to go down. Above all, we don't want it to go down. So neutral to slightly bullish. The reason we're not full on two hands bullish is because we miss out on that upside. We don't want it to go up too much because then we're going to be mad that we sold that cover call. Similar process to the cash secure put. So in this case, we sell one QRS put for 90 strike. We bring in $1 of premium, aka $100. We set aside $9,000 to cash secure that option. So then what happens? Well, as long as the underlying stays above $89, specifically stays above 90, we get to keep all that premium. If this put gives someone else the right to sell the shares at 90 and they're above 90, they're not going to exercise it. The option expires worthless. We get to keep all $100. There's not that a stock appreciation aspect on the cover calls because we don't have shares to appreciate. We just have the put itself. Anything below $89, though, it's going to be downside risk for us. It's going to be effectively the same sort of risk as having 100 shares long because that's effectively what we have. We effectively have 100 shares long because someone else has the right to make us buy 100 shares at $90. And that's the issue that we have to run into. So in that case, what does it effectively look exactly like? It looks exactly like that relationship on a covered call. We have capped upside potential. We have substantial downside risk. The analogy I always like to think about it, imagine some stranger just approached you on the side of the road and said, "Hey, I've got a proposition for you. We are going to, I don't know, play a game, do some sort of contest, but the end result is you are either going to get $100 or you're going to have to pay me $9,000." Who's interested? Who wants to do that? Who's immediately wanting to enter into that transaction? Not a lot of people. You might be saying though, all right, well, I could either make $100 or lose 9,000. What are the odds? What are the odds that I make $100? What I lose on 9,000? That's really the thought process to most of these trades. It's not just the simple nature of best case, worst case scenario. It's really what are the probabilities aligned with it. And to be fair, the short option side of the equation are generally going to be higher probabilities. You're more likely to get that $100 than you are to lose that $9,000 because effectively you need the stock to go bankrupt to lose 9,000. But what are the likelihoods that you could make $100 versus lose $400? Those are a lot more closer to 50-50. That's that asymmetric relationship still. Capped upside potential, capped best case scenario. Best case scenario, we can make $100. It doesn't matter if the stock quadruples, goes up 1,000%. All we can make is $100. Anything below that $89 level, though, we're at the whim of the market. Any sort of relationship is the same sort of thing. Now, the fun thing about that same perspective, we can do the exact same methodology back test on a cash secured put on Fidelity Active Trader Pro. So remember, 2-year stock return for SPY last 2 years has been 14.5%. Let's see what a cash covered put strategy would have done. Only about 8 or 9%. Why? Well, market was more likely than not trying to price in more downside, and you didn't get paid much for that because the market kept going up. Nvidia, what did we say, 40%? This one only made 23, maybe 30, maybe 33. It might have had some periods where it might have worked out just fine, but ultimately we didn't see that same sort of relationship. Now, what about Beyond Meat? Remember that one kept going down? You actually were positive selling cash cover puts. How? Well, how could that possibly be the case? Well, it looks like it likely the market didn't go down as much as what the market thought it would. That's what creates scenarios for this, is that we are taking a transaction, we're taking a stance effectively that the market's not going to go as far down as the market thinks it will. And then the totality, hopefully we get paid for that. QQQ, another example for this. Let me switch over to the cover calls to see what it's done. 17, 16 or so percent. This one, 9, 12, 14 to the left. In that scenario, the cash secure put, cash cover put did not work as well. Now, you might be familiar or have ever heard of the wheel strategy. All that effectively is rotating between these two strategies. If you think, hey, I've got these shares, I'm going to sell cover calls against these shares. I'll keep doing that until I get assigned. You get assigned. Now you've got a pile of cash that you could use to buy back the shares, but instead of buying back the shares, you just sell a cash covered put. And you keep doing that until one day you get assigned. Now you have those shares. Now you sell the cover call. That is the simple nature of what a wheel strategy is. We're just rotating between these positions based off of whatever we got assigned at last. Now, I've mentioned I am skeptic of really any strategy that says you can do X, Y, or Z based on the passage of a time or day and that it will effectively work out. Because to me, the market's a pretty good system of figuring out strategies like that. Because if there was something that you could simply every day, every week, every month do the exact same thing, why would someone take the other side of that transaction? So where do cover calls, cash secure puts fit into the mix? Well, I like the thought process of being a little bit more discretionary in that sense. Maybe if, maybe benefit of hindsight here on something like QQQ. Imagine you had been seeing this sort of move higher during these periods of time, especially around this period, and you're thinking, all right, maybe we are prone to slow down. Maybe you had the foresight during this window to say, all right, we've been just screaming higher. Maybe we've got some likelihood of slowing down here. The market might be overpricing some upside. And you sold a call. And what have we done basically since, what was this, October of last year? We more or less went sideways, maybe went slightly down, but more likely than not, had you sold call then, you would have done just fine. And maybe you were okay with selling a 650 strike call because you said, if I get out of it at 650, that's fine. The thought process of it being a pseudo style limit order of sorts is taught to from time to time. I will say the only thing you have to consider is that if you were going to put in a limit on QQQ here at 650, if it ever hit 650, even for a second, that limit order would fill. A cover call doesn't quite work like that. It really has to go above, stay above 650 for you to really be assigned. So it doesn't give you the guaranteed exit, but it does pay you a little bit of money. So that's the thought process, is that maybe some people, they're okay with not getting an actual exit like a limit order would be, but they are willing to bring in a couple dollars of premium because of that trade-off. Or maybe you're saying, the classic phrase people will say in scenarios like this. Let me move to say NVIDIA instead. Imagine you realize that right this moment, NVIDIA, and maybe I say this theoretically, let's just go look. Right this moment, the 150 strike is willing to pay you $1 for that. If you've ever said something to the effect of, hey, you look at the chart and you're like, I would love to buy shares of NVIDIA at 150. If it got down to 150, I'd be buying it. Well, you could put a buy limit order out there, and if it got to 150, it would theoretically fill. Or could you bring in $100? If it doesn't fill, then hey, you got $100. And if it does go lower, then you have the shares you wanted at 150 or so. What is always the issue that we have to run into? Well, imagine you say, I would love to buy it at 150, and all of a sudden, it not only goes to 150, it goes to 100. Now, do you feel as good about the buy at 150 as you once did? That's the issue that we have to contend with. There's no way to know the future, folks. We don't have a crystal ball. We can only just trade based off things that we see and the moment in time that we are at and make decisions accordingly. No, I've been going for a bit of time, though. I want to give Albert plenty of time before we wrap up. Anything that you wanted to add, Albert, to those two strategies?
Yeah, the other thing too, and is if we think about, for example, in the push scenario, what if we're looking at that put, and I'll actually grab the screen real quick and we can, I'll walk through this real quick. Um, what if we are looking at a particular situation and we decide that, we want to be able to participate in this movement in SPY, and we think that based on our assumptions and our analysis that if SPY was to get down to, say, the lows back from October, November, somewhere in the 650 range, then we think it could find some support there and start to move the opposite direction. So we say, hey, listen, I'm okay with selling a put here. And if I get executed and I get to own this down here in this particular level, I think that's going to be the right spot to be in. So we saw the 650 put or the 655 put, whatever we decide to do. What's the issue as we progress lower towards the strike prices? There's a couple of things we have to think about. First and foremost, unlike a limit order, we can't just cancel it, right? We actually have to close out the position. That means that if we sold to open a cash secured put at 655, for example, that means we're going to have to buy it back. Well, what's the issue as the stock moves in that direction? If the stock is going to continue moving lower, right? Let's say that the stock started does this thing right here and just kind of moves around and eventually moves lower over the course of several weeks, right? Then the issue is going to be that we have to go and buy that back, right? We have to go and buy that back and get out of that positions. Well, if the stock's moving lower, the put price is probably what? It's probably going up if we're moving lower. The other issue that we have to consider is that when we think about levels of volatility, well, volatility, we normally think of volatility moving up in the direction of panic. And since we're mostly long traders here from the retail side, we would think that the downside on SPY would be the level that we would see volatility move up in. And especially if we saw it move quickly, we would expect volatility moves to move higher. So think about that scenario as you consider this particular trade. You have sold a put because you want to bring in that premium that you'd get for that particular option, and it's moving down rapidly. And now you're getting a bit nervous saying, I don't actually know if I do want to own this particular situation because I think if it doesn't find support there, it could go a lot lower. So now you're faced with the situation where you actually have to go in and buy that put back. Well, not only have we moved in the direction of the puts, you're going to be swinging against that current, but potentially volatility is even higher, causing the price of that option to be even higher. So now you're really swimming against the current on two different factors that you have to deal with. So I know somebody had mentioned earlier that it was if you put these together, I think it was Deirdre said this, if you put these together, this is the wheel strategy. Yeah, yeah, absolutely. Lydia, sorry. Lydia said that's the wheel strategy. And absolutely it is. Well, what could possibly go wrong with the wheel strategy? Well, again, you're using that put to get yourself into a position, but I want to show you this one because our friend Matt Davidson showed me this one, and it's just the perfect example of how things could go poorly in a wheel strategy. And that is that we're looking at something that, hold on, I didn't change there. We're looking at something that we're deciding to sell uh, cash secured puts on. Actually, this was a cash secured puts. And let me go back to roughly a year. Yeah. The situation was in this area right here. So I'll even kind of just zoom this in a little bit. In this area right here was a situation where somebody said, this thing is on a tear, it's going higher. I'm going to sell some cash secured puts just to bring in some extra income. So they do. And the next thing you know, the stock actually drops through the strike price and it continues to go. So what happened? Well, they ended up buying the stock at $60 and now it's trading down here at 30 or 31. Well, what's the next step, folks? The next step is to sell a cover call in the wheel strategy. Well, in order for you to get to a situation where you're not going to be losing a ton of money, what do you have to do? You either have to write something that's strike price way up here close to where your cost basis is, which probably doesn't really net you a lot of capital for that sale, or you have to go out way far away in distance and be locked into that trade for even longer. So part of the issue with doing these types of trades is that you're locking yourself in and you're potentially missing out on opportunity costs, right? You're taking on opportunity costs because you're not able to deploy your assets in a meaningful way because you are stuck in a trade that maybe isn't the right trade for that particular scenario. In this scenario, if you would have bought it and then you sell something that's close to at the money down here to bring back some premium, what happens here? Well, the stock shoots right back up. And so now you end up locking yourself into selling at a bad level that locks you into a loss. So yes, Andrew is what his concerns are absolutely valid. There are right situations for both of these trades, but just really make sure you understand the obligations of these trades as well, because you can easily, and again, on the service side, I've taken many calls. My cover call is weighing the money. How do I fix this? Well, there's no fixing it. It's done what you wanted it to do. It's gone up, and now that call is going to be worthless, and you get to keep that premium. So understanding the obligations and really the environment where these kinds of trades are useful is going to be key to being successful at using these trades. Make sure you don't think that the cover call is a bullish trade, for example, because that is absolutely not the case. Uh, the other thing too is if you're doing these things and you're doing them way far out, don't forget you're locked into that trade. If you do a cash secured put that's a year out because the premium was so great, that's fine, but that cash is locked up for a year. And then the question becomes, is there something else you could be doing with that cash in that amount of time? If you're doing it shorter term, a month or so away, that's a different story. But nonetheless, it's still locking up, and there still is risk to those trades, especially from a cover call. You still have the stock, right? You could absolutely write cover calls, but as Andrew showed us, like for Beyond, for example, you still have the stock, and you're probably not doing as great on the downside. So hopefully that helps. Again, these are the kind of ideas that we want to think about when we're looking at these types of trades. Selling options is something that is good in the right scenarios, but not every scenario. So make sure you understand what those scenarios look like as you progress with these types of trades, keeping in mind that there's a time and a place, just like buying options. So hopefully that makes sense, and hopefully all this stuff is starting to come together. Next week will be our last week. Next week we're going to really get into the trade management. We've done the trade now. What things to think about? We'll kind of tie it all together and hopefully put a nice bow on it and let you off into the world with your option knowledge. And again, if you feel like some of this was a bit much and you want to come back again, we're absolutely happy to have you again next month. We'll do it all over again. If you felt like you had a good grasp on what it is that options is or doing, or at least what we've been talking about, we have options intermediate. We'll get into some of the more complex topics such as volatility and spreads and Greeks and things like that. So you have choices, and we are here to help you with that. By all means, feel free to join us for that. Again, we'll be doing that selling puts here in just a couple of days on Wednesday. Just a full hour of talking about selling puts. So I'm sure there'll be more conversation to be had about the risks and rewards of selling puts. But Andrew, I'll leave the final words to you. Again, thanks for being here, everybody. Andrew, always a pleasure. Hope everyone has a great day and a great rest of their week.
Yeah, I couldn't agree more. Can't emphasize enough, folks, that there's a natural, I call it just naturally human optimism. We like to think that stocks will eventually always go up. Unfortunately, I think the stat I remember is that for every stock that goes down more than 50%, I think only 15% ever recover. So we have to be very careful. We have to be very selective. I think the other stat I always remember in my mind is that 90% of stocks underperform cash throughout their lifespan. So being a stock picker is a difficult venture. We have to make sure that we are risk managers first and foremost, and we understand what we are knowing and getting into every time we place a trade. So appreciate everyone joining us as always. Look forward to seeing everyone in these future sessions. Hope everyone has a great day. Thanks.